Jack and Matt are brothers and they both made $130K in 2022, but in very different ways, which caused their tax returns to look very differently. Matt is a boring financial analyst who works most of his time, and Jack is a video editor who works for a small media company but also runs his own side hustle. In his free time, he records audiobooks for various authors and runs his own podcast. Which way is more tax beneficial and why? Let's explore the two scenarios. Matt is allowed to work from home most of the time, but sometimes he needs to go into office. Because of that, he dedicated one room in his house as his office space where he primarily works from. However, because this is not for the convenience of his employer, and his employer actually provides him with an office space that he can use on a daily basis, he cannot deduct any home office related expenses on his tax return, which makes his taxes very straightforward and extremely simple. So let's take a look at his 2022 individual tax return. He has wages of $130K and he files as a single individual, so his standard deduction is $12,950, which makes his taxable income $117,050. This amount causes his tax liability for 2022 to be $21,928. The employer withheld $22,000 from his salary, so he actually overpaid a little bit for the year. Jack also receives a W-2, albeit his salary is smaller, only $75,000. However, he makes up the income difference through his side hustles. He made $55,000 by recording audiobooks and running his podcast, and because of that, he also incurred some necessary business expenses that he can deduct from his tax return. For example, he purchased a microphone, he had to purchase wires and software for $215, and also paid $200 for an accountant to prepare his tax return because it was a little more confusing for him. So overall, $415 is definitely deductible from his taxes. When it comes to his home office, because he has to record high quality audio, he had to dedicate one room in his home specifically for recording purposes, but he also uses this office to do his research for podcasts and also all admin related stuff. So because Jack has a side hustle and he uses his office in his home, he is allowed to take deductions in relation to this office. However, there are certain things he can and cannot take on his tax return. So let's explore those things. First of all, he had to install those noise canceling decorations in the office because those reduce echo and make audio much better quality, which apparently I need to do probably at some point as well. And that cost him $150. This is a direct expense toward his office, so that is also fully deductible. So when it comes to indirect expenses such as mortgages, real estate taxes, insurance, utilities, we can only deduct the portion of these expenses that is allocated to the office itself. So the way to calculate that is by using the business use percentage, which is basically the square footage of the office itself over the total square footage of the house overall. So let's assume in our case that the office size for Jack is 475 square feet over the total home size of 2,300, which gives us a percentage of 20.65. This number 20.65 is the magic number. It means that 20.65% of the total house is being used for his side hustles, for his business. And so the indirect expenses, all of the indirect expenses need to be multiplied by 20.65 because that's the business use percentage of his house. It's not a separately stated unit, it's within his same house, so you have to calculate this business percentage. Mortgage, real estate, insurance, and utilities are $8,600. We multiply by 20.65%, which gives us deductible indirect expenses of $1,776. And as I said, for depreciation purposes, let's just assume that $2,383 is the allowable depreciation that he can deduct, giving us the total expense for his home office, including the direct expense of $150. The total is $4,309. Let's go back to Schedule C, and we'll see that his income from audiobooks and podcast production is $55,000. We deduct $415 for the necessary business expense, and we deduct the home office expense of $4,309, giving him a net income from his side hustles of $50,276. Okay, let's be honest, if Jack only had to take his business income minus business expenses and be done with his tax returns, it would have sounded way too good to be true and way too easy, right? Of course. So when it comes to any type of income, whether it's from a W-2 salary and wages or self-employment, we're all responsible for paying Social Security and Medicare taxes. Social Security being 12.4% and Medicare being 2.9%. However, when you're an employee and you receive a W-2, your employer is responsible for half of Social Security and half of Medicare, and you're responsible for the other half. So this entire amount of 15.3% is divided by 50-50 between you and your employer. However, if you have self-employment income and you don't have an employer who would pay 50% of the Social Security and Medicare, you're responsible for the entire amount. You're responsible for the entire Social Security of 12.4%, and you're responsible for the entire Medicare tax of 2.9%. making you responsible for the entire 15.3% of Social Security and Medicare, called self-employment tax. So self-employment tax in Jack's case is $7,000, $7,103 to be exact. I should probably make a separate video about self-employment tax and Social Security and Medicare specifically, because Social Security is only taxed on your first $147,000 of income, and there is an additional Medicare tax if you make more than a particular threshold. For an individual taxpayer, I believe it's $200,000. Those amounts may change based on inflation and things like that. So, but for now, Jack's income is less than 147 grand, and he doesn't make more than 200 grand, so he is good. So now you're thinking about this and you say, well, this is super unfair because Jack is working just as hard as Matt is working, and why is he responsible for the entire Social Security and Medicare on the portion of his self-employed earnings? Well, it is unfair, and because of that, there is actually an adjustment to income, which is a deduction from Jack's income to reduce his adjusted gross income, which in turn reduces his taxable income. That adjustment is equal to 50% of his self-employment tax. So his self-employment tax is $7,000. The adjustment to income is $3,500. Well, let's look at the tax return to look closer. You will see the $7,103, his self-employment tax, and his adjustment to his income on line 10 here is $3,552, which is 50% of $7,103. Schedule 1 Part 2 adjustments to income, line 15 says deductible part of self-employment tax. You do have to attach Schedule SE, which stands for self-employment tax, and you will see the calculations made on this form. Qualified business income deduction, also known as 199 Cap A deduction, is basically 20% of your self-employed net income deduction. That's probably a topic for a separate video, but for these purposes, Jack's activities, Jack's side hustle does qualify as qualified business income. And so to calculate the deduction, it's actually pretty simple. You take the net income from his business, $50,276, and you deduct the deductible part of self-employment tax. 50% of self-employment tax, $3,000. You deduct that amount and you derive at $46,724 for Jack, which is the amount of qualified business income. This qualified business income we multiply by 20%. That gives us a $9,345 deduction on his tax return that you can see here on line 13. Overall, Jack has a few deductions: his business deductions, home office deduction, the deductible part of self-employment tax, and the qualified business income deduction, which all together reduce his taxable income to $99,429. $17,698 is the amount of tax liability that Jack needs to pay. However, do not forget about the self-employment tax that he's responsible to pay, because it was his side hustle. No one was withholding the self-employment tax from him. No one was withholding Social Security and Medicare taxes from his side hustles. So he has to include that on his tax return, which is $7,103, the entire amount that he's responsible for. He had already taken 50% of it of his income, which reduced his taxable income, but he needs to pay the entire amount. $7,103 is an additional tax liability on his tax return just because he was making his own income, not as an employee. As you can see on his tax return, $17,698 is the tax liability plus $7,103 self-employment tax, giving the total tax liability for his 2022 tax return is $24,801. Jack's employer did withhold some of the tax from his W-2, specifically $14,500 was withheld. But because Jack was making extra income that his employer wasn't aware of, and potentially this income wasn't evenly earned throughout the year, who knows, Jack had to make estimated tax payments every quarter on his own, and he would go to the IRS website to make estimated payments online himself, which he did, and overall the amount that he paid was $10,400. So overall he did pay $24,900. Which is an overpayment of $99 that he can either take as a refund or apply to next year. So let's get to the part where we compare Matt's tax return and Jack's tax liability. So you will see that Jack actually has a lower taxable income of $99,429 against what Matt has of $117,050. However, because of the self-employment tax, Jack's overall tax liability is actually higher than what Matt has. $24,801 versus $21,928. Also, at last, I wanted to do a very quick analysis of office deductions, because technically deducting actual expenses is not necessary. If you don't have enough data, or you don't want to hire someone to help you with tax returns, and you don't know how to calculate depreciation and all of that stuff, you can use a safe harbor rule. The safe harbor rule says that you can deduct $5 for every square footage of your office up to 300 square feet. So there is a limitation on the amount, the dollar amount, as well as the size of your office, which gives us, 5 times 300, $1,500 of maximum home office deduction. If you don't take actual expenses, I would say it's not super recommended, because as you can see, as we'll see from Jack's perspective, it actually hurts his position even more. So for the purposes of this example, let's keep everything the same. Jack has made the same $75,000 of W-2 wages and $55,000 from his side hustle, and he also paid his necessary business expenses of microphone, software, accountant, $415. When it comes to office expense, if you're using Safe Harbor, you don't need to worry about the actual expenses. You don't account for the decorations, noise canceling things. You don't worry about mortgage, real estate, insurance, utilities, and depreciation. You just take the Safe Harbor, which is $5 times whichever is less, 300 square footage, or the actual size of the office. We know that Jack's office size is 475 square feet, which is higher than the threshold for the Safe Harbor. So we can't take 475. We have to take 300 square feet times $5, giving us $1,500 as a home office expense for Jack if he uses Safe Harbor, which derives at 53,085 of income from his self-employment on Schedule C versus 50,276 that he would have had he used actual office expenses. And because of higher income from his self-employment, obviously he will have higher self-employment tax of $7,501 versus $7,103. And I mean, the good part is that he gets a higher adjustment to his income, a higher deduction. 50% of 7,501 is 3,750 approximately. His adjusted gross income is 124,335, and his 199 cap A qualified business income deduction is also a little bit higher because now we're taking 20% of a slightly higher amount. So you see here we have 53,085 of his business net income. We subtract the deductible part of self-employment tax. That's the rule, you have to subtract it. 3,750, which gives us a qualified business income of 49,335, and the qualified business income deduction is 20% of that, meaning 9,867. So his taxable income now is 101,518, and that produces a higher tax liability, obviously, of 18,200. And if you add a higher self-employment tax of 7,501, the total tax liability for Jack, if he uses Safe Harbor rule, is 25,701. So if we compare Jack's Safe Harbor case scenario with Matt's scenario, Jack will actually pay almost $4,000 more in tax than Matt. So when you compare yourself to others and you say, well, I've made the exact same amount as this other individual, but for some reason we pay a different amount of tax at the end of the year, that's probably why. You probably have different sources of income, you probably have different life circumstances. I hope this video was useful or informative to you in any way. I'm a New York licensed CPA, and on this channel my goal is to empower you by uncovering the mysteries of US income tax and broadening your perspectives. While this channel and the videos overall are informative, they're by no means a complete tax guide and should never be taken as professional advice in any way, shape, or form. The videos are also not educational and not eligible for CPE credits. If you want to learn more about me, check out my website and LinkedIn profile, and I hope to see you in the next video. Bye!